First things first, shout out to Max. Welcome to MMO Gang. He made £135 of oil. This is the type of messages I want to see in my DMs. If you want to shout out in the next video, follow me on Twitter and at me or DM me. Alright, let's get it. It's Poku Banks, and today I'm going to teach you about the 5 asset classes that you can invest into. Let's waste no time, let's get straight into it. Asset classes are a group of different investment vehicles used by investors to gain a positive return. They all vary on different levels of risk. Now let me tell you something. In this video, we're playing with big numbers only. Reason why I'm using big numbers is because 1, me and you are on this journey to wealth. So there's no point using small numbers where we're going to use big numbers for our examples. Okay, so let's start with why people invest. Firstly, creating wealth. This is a simple one. People want to create passive income for themselves. They invest their money into a certain security or certain share or a certain commodity in returns for positive gain, a positive capital gain in their money, so they can sell it and make a profit. Another reason why people invest their money is for retirement. People want to retire stress-free. No one wants to be working till they're 75 in Tesco's. Comment what age you want to retire and say why, because I'm not trying to be working after the age of 50, trust me, no way. Now I'm not sure if you guys are aware of the FSCS, you've probably seen it, it looks like this. Financial Services Compensation Scheme. It protects you with funds up to £85,000. So say if a wealthy person has £1 million, it will not be wise for them to put £1 million in the bank, because say if Barclays was to go bankrupt tomorrow, they would only get £85,000 back. So you have to divide it equally. Alright, so the first asset class is cash. C for comfort. Now cash is just an everyday asset that everyone has. Everyone has cash in their bank accounts, everyone has cash at home. Now the reason everyone loves cash as an asset is it's quick and easy to access, and it provides good diversification benefits. You can use your cash to put into other asset classes. That's why it's so good. This means you put your money into X, put your money into Y, put your money into Z. But what if I told you that cash is actually the weakest asset out of the 5? Allow me to explain. Now there's something called inflation, the gradual rises in prices of goods and services. As inflation occurs within the economy, the value of your cash is decreasing. And as it's decreasing, you'll get less purchasing power. A lot of investors that have a lot of money lying around, they want to save money effectively to beat inflation. Let me just put an infographic on the screen so you can understand it a little more better. Now the Bank of England, they aim for 2% inflation every year. Now theoretically, let's say you had £1 million in the bank account. If inflation was 2% for the year, your £1 million is now worth £980,000 in real terms for the year. Don't get me wrong, your money will still show as £1 million in your bank account, but your £1 million can only now buy £980,000 worth of stuff. So essentially, you have now lost £20,000 for doing nothing with your money, literally. And this is why people invest their money, to keep up with inflation. Now the best way for your cash to keep working for you is fixed term deposits. The reason it's fixed is because they're guaranteeing you that interest rate. Now you lock your money away in a savings account which you cannot access for a certain period of time which you decide. Once the term is over, you'll get your principal money back, the money you invested, plus interest. Now don't get me wrong, the interest isn't that crazy, it's nothing too special, but it helps you keep up with inflation. Just look at how small the interest is. Imagine investing £2,000 and getting £42 profit after 3 years. I feel like that's daylight robbery personally. And it's low risk, so you get no reward. That's what I thought. Hey, but don't forget to hit the like button, subscribe, This 100k won't come by itself. Now the second asset class is bonds, B for boring. And in this case we're talking about gilts. This is the UK version of bonds. Government and corporate bonds are debt securities which are issued by the government for you to invest in. The money that you've invested is used for government spending and investment within the economy. They are now obliged to pay you on a periodic basis. This is known as coupon payments. So this could be every 6 months. These bonds can last from 1 year to 30 years or more. This is called the maturity, the length of the bond. Now let's say you bought some gilts totaling up to £1 million from the UK government. It has a coupon rate of 5% and maturity is 10 years. This means every year you'll be paid £50,000 in interest. But it'll probably be split into 2 payments, so £25,000 one half of the year and £25,000 the other half of the year. The government will pay you this for 10 years and then at the end of the bond, they'll give you your £1 million back. Now the reason a lot of investors buy bonds is because these are seen as low risk investments. The reason they're low risk is because the government is very, very unlikely to default on the payment. It's not impossible, but it's very, very unlikely for the UK government to default on your payment. Now, corporate bonds are the same, but they have a lot more risk. Why? Because companies can fail at any time. And since companies are more likely to default on your payment, you get high interest for investing in them. I'll show you some now. Although I said that most governments are unlikely to default on your payment, beware, there are other countries that will default on your payment. Like for example, if you remember Greece in the Eurozone crisis. Now the coupon rate, the interest, can be either fixed or index linked. Now conventional bond is what I explained before. It is a normal government bond that has a fixed interest rate from the beginning. Now the UK were the first to introduce index linked government bonds in 1981. These are government bonds with an interest rate that is linked with inflation. This means it matches a retail price index. So as inflation rises, the interest rate also rises with it. So then you're covered for inflation. Whereas with conventional bonds, the interest rate is fixed. So if interest rates rise elsewhere at other banks, then the government bond that you have is not worth as much, as there's better alternatives elsewhere. And the best thing about them, they can be bought and sold, so they're pretty liquid assets. Now after explaining all of that, now you understand why I call bonds B for boring. And the third asset class is commodities, C for classic. And the reason I say C for classic is because commodities have been around since the beginning of time, essentially. They've been trading commodities since the caveman days. This is known as bartering, trading goods and services. Now commodities are simply basic goods like iron, copper, oil, gas. We've got precious metals like gold and silver. We also got agricultural commodities for like wheat and rice. But just like shares, they rise and fall based on supply and demand. If there's way too much oil, then the price of oil goes down. If oil is very, very scarce, then the price of oil goes up. Simple supply and demand. Now, one reason why investors like commodities is because they benefit from inflation. Like I said earlier, inflation is defined as the gradual rise in prices of goods and services. Commodities come under goods and services, so if inflation is increasing, that means the value of gold, wheat, oil is also increasing. So it works out, it's a win-win situation. But now the biggest problem with commodities is that since they're materials, they don't actually produce any income. You can simply buy them and sell them for a higher price. They don't give you any payments like bonds or any dividends like shares. But there is a few ways to invest in commodities and get regular income like dividends. The first way is simply to invest into mining companies or commodity companies. So for example, BP. Another way you can invest into commodities is an exchange traded fund, something like the Vanguard Energy Index Fund. This is essentially a big group of all the world's biggest commodity companies, all in one big fund. So you can invest directly into a certain sector like gold, so it will only be gold mining companies, or oil, so only oil production companies. Now the fourth asset class that you can invest in is property, P for progression. The reason I say progression for property is because at the beginning of civilization, property looked like this, and now in 2020, property looks like this. That's just pure progression. You gotta admire it. Now, if you didn't know, I'm actually involved in the property market, and I'll tell you this right now, there's so many ways to invest into property. I can't even cover it in this video. You know what? You can get a separate video for that in the future, trust me. But let me just go through the basics of property. Let me just go through the basics of what you can invest in property. The main two ways you can invest into property is either through funds or brick and mortar. So an example is, the house I'm living in right now. Buying the house, that is an investment, brick and mortar. This can either be residential, so where families live in, or commercial, where businesses take over. Now funds, these are essentially real estate investment trusts. Now this is where you, the investor, can invest into real estate development companies or real estate investment trusts. You, the investor, benefit where you see the share price increase, so that's capital growth, or dividend payments, so you get regular payments. But let me just tell you this now, the thing with brick and mortar is that they are illiquid assets. When I say liquid, that means it's not easy to turn into cash. Yes, a house may be worth 500k, but if you really needed 500k tomorrow, you cannot, you can't look at your property and think, oh, okay, let me just sell that and I'll get 500k tomorrow. No, it's an illiquid asset. Compared to bonds or equities, this is very, very liquid, because with others, you can get your money out the same day or the next day. Now, to be honest, it depends on you, the investor, on which side you want to invest in. Now, for me, I'm a brick and mortar guy. When I want to invest in property, I want to actually see the property with my eyes. I'm pretty sure a lot of you can agree with me, but it's just a nice feeling to know that, wow, this space is all mine. This is all mine. This is my property. This is my premises. And now there are other investors that just want to invest in funds. They don't care about the physical maintenance of the property. They just want to see numbers. They just want to see money go up. Now all you've done is just invest into a company that's doing it for you. All you're seeing is numbers going up. You're not actually getting involved. So again, it's all down to you as the investor, really. Now the fifth asset class that you've been waiting for is equities. E for excellent. Now I pretty much explained equities in my last video, how to invest £100 in UK 2020. You can check it over here. Go check it over there. It'll be just over there. Just click that out. That's pretty much explained all the equities. But I'll go over it again briefly. The reason it's called equities is because you own equity stake in the company. You're buying a small share of a company where you are aiming for capital growth or dividend income. Now, dividend is a share of the earnings, which is paid to you on a monthly or quarterly or yearly basis. Let's say the dividend yield was 4% and they're paying on a yearly basis. If you was to invest £1 million into, company X, which has a dividend yield of 4%, that means every year you'll be gaining £40,000 in income. That's for you to either live off or reinvest. With that dividend payment, you can use that money to reinvest back into the company. Therefore, you get a bigger dividend income. That's 4% of 1,040,000. I don't know what it is off the top of my head. I'll put it on the screen. Now, at the end of the day, let's be real. Not everyone's good at picking stocks. Not everyone's good at researching. And, not all investors have time to even look into stocks like that. So there's something called equity funds. An equity fund is essentially a group of professionals that will invest your money into stocks of their own choice on your behalf. As they are professional, they know what they're doing and they can do all the work for you for a small fee. Now here's a disclaimer: I'm not a financial advisor. I'm not a millionaire. I'm not an accountant. Although I do accounting, finance and management at uni, I'm none of those. You see me, I'm just a young kid that loves to talk about finance, okay? Now out of the 5 asset classes, obviously everyone has cash. I'm very, very interested in property, and equities I'll be very, very interested. And you see with bonds, there's more of people with a lot of money to play with. Now let's say Warren Buffett was going to invest $5 billion into a bond with a coupon rate of 5%. That's literally $250 million in interest right there. But yeah, I hope you enjoyed that, MMO gang. I appreciate all for getting to this point in the video. Just to prove that you got to this point in the video, just comment one thing that you didn't know today, that you learned today in this video. And if you knew everything that I said in this video, teach me something in the comments. I will definitely reply to you. So do that, please. You already know, man. It's Poku Banks, baby.